Dr. C.K. Narayan is Managing Director, Growth Avenues. He's joining me right now from our studios here. Thanks very much for coming in, sir. You know, just off the camera, we were talking about what's happening to the market, and I'd like to start with that, if you don't mind. You were saying that logic seems to be the biggest enemy to making money in this market, right? Let me repeat that for our viewers. You're saying that logic seems to be the biggest enemy in making money in the market. Can you explain that?
Well, if you see, most of us have got spooked first and foremost by the levels in terms of valuation that the markets are trading at. And everybody is very rational, being very rational about it and saying that, you know, it's at about 20, 21 times trailing PE. There is no signs of any growth. You know, all sorts of problems are being enumerated one after the other. And you have really not had a dearth of them. You know, everybody wants interest rates to be cut, but Reserve Bank is not really ready to oblige. Unseasonal rains are damaging crops. You know, leaders of various industries are kind of grumbling that you're not seeing things at the ground level. Big bang reforms are not happening. So if you want to list, you know, litany of woes, then that list is pretty big.
But you know, it's kind of uncanny. But there's a great there's a guy called Stanley Druckenmiller who was
with Soros.
Was Soros, right? Yeah. And he in his sort of in an interview actually, and I'm going to read out a small excerpt. It's the reason I said it's uncanny is because actually I was reading this again this morning, and you mentioned this, and it kind of fits in. So allow me exactly, you know, 60 seconds to read this out. So this is Mr. Stanley Druckenmiller in an interview, a very old interview actually, and the question is, tell me about your early experiences as a stock analyst, and his reply is this: the director of investments in his early career. The director of investments, who was his boss, who had hired me, was brilliant with a great aptitude for teaching. He was also quite eccentric. When I was 25 and had been in the department for only about a year, he summoned me into his office and announced that he was going to make me the director of equity research. This was quite a bizarre move, since my boss was about 50 years old and had been with the bank for over 25 years. Moreover, all the other analysts had an MBA and had been in the department longer than I had. You know why I'm doing this, don't you? He asked me. Mr. Druckenmiller said, no, I don't know why you're doing this. For the same reason they send 18-year-olds into war. Why is that? I asked, that is Mr. Druckenmiller. His boss's reply was, because they're too dumb to know not to charge. The small cap stocks have been in a bear market for 10 years, and I think there's going to be a huge liquidity-driven bull market sometime in the next decade. Frankly, I have a lot of scars from the past 10 years, while you don't. I think we'll make a great team, because you'll be too stupid and inexperienced to know not to try to buy everything. That other guy out there is just as stale as I am. I think it's a fantastic little exchange in that interview, and it kind of tells a lot about, you know, what you call the Regency effect, and, you know, being too influenced by history, too bogged down by it. And those kind of things. At the end of the day, it's all psychology, right?
Absolutely. I think, see, that's what the market is doing, right? Every fiber in your body of rationality is kind of screaming at you not to buy this market. But look at what's happened. Let's take, you know, forecast for the Nifty earnings. At the start of the year, everybody said 15% would be the, you know, expected earnings on the Nifty. And now that's been downgraded, and we are now at about 5%, and that 5%, I think we are being charitable about it. Expectation for Q4 earnings is maybe down in the basement. 2 weeks ago, I was at a kind of a party where all these market bigwigs, you know, the bulge bracket brokers were there. And the consensus there was that for 2 quarters, you could probably forget about earnings and therefore forget about the market. But then this is the market where not very long ago, let's say about 10 days ago, everybody was saying 7,000, 7,500. And then we are now closer to 9,000. And
I'm interested in that party that you were referring to. You're saying the consensus was that amongst the big Mumbai brokers, right, was that forget about the market for the next 2 months, which is the market isn't going to do well.
Yes, right. They were saying that, you know, the FIs could buy all they want, but then earnings on the ground are not really changing, and I don't see them changing for Q4 of this year and maybe Q1 of the next year. So I think the the feeling again, but I would put this purely to the rational state of the mind, which says that if A has to happen, then B has to follow.
Yeah.
Or rather, if B has to happen, then A must be in place for
Yeah.
B to happen.
Yeah.
But the market seems to have completely different designs, and I think that is what I would very much echo this boss of, let's say, Druckenmiller, who says that you have no scars, you're too dumb. So I think it's the dumb guys in the street who are really making money hand over fist today, and all the smart guys are actually looking at saying, look where is the earning, look where is the PE, and look what is, and they are not buying stocks.
Yeah.
So there's a lesson there for all of us.
But is there a smart argument one can make about buying stocks as well? Let's put it that way.
Well, I think the only smart argument that you would have right now is not to look at the tried and tested paradigms. This market is clearly signaling something else. It is probably looking at what the rest of us are not really looking at, and we don't know what that is. So the best way I would say is to follow the trend in the prices, and I think today technical guys are making a lot more money than probably fundamentally oriented guys, because they are like those...
P ratios don't constrain you in that sense,
exactly,
right?
P ratios don't constrain you. You're looking more at momentum, you're looking at breakouts, you're looking at stocks sort of charging upwards into new all-time highs. And there is a legion of them which is just going higher and higher, and four-digit stocks are becoming even larger four-digit stocks, and three-digit stocks are graduating to four-digit stocks.
You know, as someone, I don't remember who said it, but you got to decide whether you want to be right or you want to be rich. Right? I mean, so sometimes it's either or.
Yeah.
It can't be both. And if you're in it, then you have to be in it for the money, to make the money.
The way it is actually put on the technical side is that if you want to be an analyst, then you're all completely focused on being right. But if you want to be rich, you want to be a trader, and that means focusing on what is happening rather than wanting to be right.
Money is pouring in. I don't know if you have any specific views about this specific class of investors called ETFs, exchange traded funds. Let's put the data up and I'll tell you the story. There's a story, by the way, in today's Business Standard. We've been focusing on this aspect for the last couple of days, but in March apparently, and I think Business Standard is quoting Kotak Securities, a report by Kotak saying 90% of all the net FI inflows into equity in March came via the ETF route. And this week, already, just 2 trading days, actually 1 trading day, but we have ETF data for 2 days. This is the money that ETFs are collecting, India-dedicated ETFs are collecting, and which they, of course, put to work as well. So in a way, similar to the money which equity mutual funds get handed over, which they then put to work. Year to date, that number is about $2 billion or so, but, last 10 days, look at the number, I think it's close to about $500 million. It kind of just explains this relentless surge up that we've seen over the last 10 trading sessions from about 8,300 or so. Those are the numbers. I don't know if you have any specific thoughts on this. ETFs are passive investors, and they just chase outperformance. If a market becomes bigger, weight increases, ETFs got to replicate that, and they buy more of it. So it's actually the opposite of what a value investor would do. Look for things which are cheap and look to sell high. I mean, these funds would do the opposite. I mean, something is doing well, they get in.
Yeah, I think if you look at it, the ETF inflow would probably be explained by the fact that India is among the highest consensus kind of go-to area within the world of emerging markets, as it were. And that would probably make ETFs, which kind of represent India, kind of natural place to go to for any kind of money which is seeking higher returns. And we are all well aware of what are the positives. We are the only country where the interest rate has to go down, and inflation is definitely showing signs of tempering. So I think from an economic standpoint, ETF money flowing into the markets is not something which I would take as being out of the ordinary. In fact, I would
my only limited point was, when you generally talk about support for the market, right?
Yeah.
I mean, if the market goes south, is there, at what level is there support? Which basically we're asking the question, what point will money come in at to start buying? You can rule ETFs out of the equation when you talk about, because they're not going to, they will vote with their feet out when the market goes south, right? So, although as a percentage of the total market, it's not very large. I think the total pool of ETF dedicated money is about $12 billion. Total FI investments into listed Indian equities is about $350 billion. So,
Yeah.
it's very small percentage, but growing very fast.
Yeah, I think what you're seeing here is a very high willingness to buy into this market, and you can also actually club, let's say, the domestic set of institutions along with this pool. They've all been waiting to plow their money back. The flow of funds from the retail investor into the domestic institutions has been pretty large. In fact, I just read recently that it was something like at a 4-year high. Now this money has to get invested, and it will come in during the pullbacks. And what we had recently was about a 9% pullback on your index, and most of the stocks actually pulled back 10-15%.
Yeah.
So I think this market is very clearly a buy on dips market. The larger players, ETF, FIs, let's say domestic institutions, or even the bulge bracket brokers, they all have the same agenda. They're all on the same page. Every major dip in the market, it seems to be bringing in fresh amount of money. And I see no way that particular trend is changing. So therefore, the only sentiment that one should exercise, whether one is a small investor or a trader, is to be a buyer on dips like the big players.
Yeah, absolutely. Any specific trades before I let you go, Dr. Narayan?
Well, I would look at various themes, in the market, because stocks are trading at a high, so it's not that everything is cheap, as it were. So one of the themes that the market seems to be concentrating on is the kind of rebuilding or refinancing kind of theory, where you have stocks like Suzlon, which is having a new story attached to it.
We had a detailed discussion with a Nomura analyst who's initiated coverage on Suzlon.
Is that a fact?
Yeah,
okay.
in the morning.
So I think
yes.
that's what is one of the themes. GMR could be one such. GVK Power could be a theme along those lines a little bit in the future. It would not surprise me to see JP Associates probably joining that that league as well. The second theme, which
it's quite interesting, because so if you're betting on these kind of names, you're not just saying that the broad economic resurgence will not only benefit the top guys, the mid-rung guys, but it'll benefit people right at the bottom as well.
Yeah.
Right?
Yes,
I mean, so you've got to have
will.
great confidence in this entire very strong growth story. Yeah. Or is it a play on a turn? I mean, a sector can do badly, but stocks can turn depending on what the company is doing, or those kind of things as well.
I think it's a little more of the latter, where people are getting focused on to companies which have been doing bad for quite a while.
Fair enough.
And the stock has taken a huge amount of beating. The names that I mentioned are probably in that particular category. And now there is a reckoning with the tide at the macro level turning. I think there is a reckoning that these stocks are probably hit their long-term lows, and therefore that is the theme which is kind of playing out in the market. The other theme is my earlier favorite theme, which we have discussed in an earlier show, that the high-price stocks are the ones which will meet with a lot of buying, and the simple reason being that there is a lack of supply. And if you take, there weren't too many buyers in Tata Elxsi in the 600 to 800 region, or in Force Motors at let's say 500 to 700 region. But then once they graduated to the 1200 and levels, then there seems to be a great deal of hunger for such stocks. I think this kind of story, this is the other thing which is playing out. So you got these two themes at two extremes. One, stocks which are in their 4 digits, and the stocks which are in their low 2 digits. I think there is a great deal of money to be made on both the sides.
Interesting. Very interesting conversation as always, Dr. Narayan. Thanks very much for coming into our studios. Great chat. Appreciate it. Thank you.